I wanted to introduce these guys, talk about the panel, and turn it over to Ken at this point to give us some perspective on the subprime market. And then once he's done, Chris will talk to us about a bigger picture on the retail side of automotive finance. So anyway, Ken, thank you so much.
Thank you, Steve, very much. Well, first of all, thank you very much, Steve, and it's a pleasure to join you up here, Chris, to talk about the auto finance business for a few minutes. But first of all, I'd be remiss if I didn't ask all of us to give NIADA a great hand for organizing this event, and thanks all of you for participating in this event. So let's start off right there. Great job. I know all of us are looking forward to this afternoon and tomorrow to hear from regulators here in Washington and to gain some insights into what may lie ahead in the automotive finance business and the automotive industry in general. But I think it's important before we do that to look in the rearview mirror for the next few minutes and look at the state of the automotive finance industry, because I think it's important to put both the regulatory environment and the economic environment into perspective. And in the next few minutes, I want to talk about the challenges in the current subprime auto finance market, the risks associated with operating in it, what challenges we have right now, and finally, the best practices that I see from successful operators. Because I think too much press is being devoted to the bad apples in the barrel, the people that are not doing it the right way. And we're going to all be judged by both the good and the bad out there. So let's get started and look at, first of all, what the current market challenges are, and we better define the subprime auto finance market. And our host last night at the great cocktail reception was Experian, and I've borrowed some Experian data because I think they've done an excellent job in helping us look at the subprime auto finance business from a 30,000-foot level. And we'll define the subprime auto finance market as shown here by credit score. And when I refer to the deep subprime, I'm talking about the market that generally finances unbankable consumers that have credit scores of less than 550. And I think that I typically refer to that as the buy here, pay here space, because so much of the financing that buy here, pay here operators do are through those consumers with low credit scores and unbankable consumers. The first thing is, let's look at the risk distribution from the first half of 2013 when compared with 2012. The good news is that if we look at the non-prime, the subprime, and the deep subprime space, we'll see that comprise almost 57% of all used financing today, used car financing. And we show almost a little over 1.5% increase in that marketplace. So good news, we're seeing a lot of activity in the subprime space, and it's growing. And even better news to this group is that 96% of all the market is controlled by the independent dealer. So you control the destiny of this market. We don't have franchise operators, we don't have manufacturers telling us what to do. We have to compete with them, but you as independents control your destiny. If we look again at the year-over-year change, more good news for the subprime industry. Non-prime, subprime, and deep subprime all are growing. So clearly they're up, with the prime and the super prime space is declining. And why is that? Because we're a country drowning in debt. We're making credit-impaired customers every day, and this sector of the market is growing. And I'm not talking about the morality of that. I'm talking about the reality of it. So I think, though, what's important to all of us is who's gaining the market share. What's really happening in the subprime space? And I think this graph is very revealing because it shows that the subprime finance companies have grown significantly in 2013, largely at the expense of the buy here, pay here space, of the bank space and the captive space. And I think what's interesting when we look at this, you look at the buy here, pay here space and you say, well, Ken, it only decreased 2%. I mean, what's 2%? We spill more than that, But what you don't see is that that's 2% of the market. And prior to that, the buy here, pay here deep subprime market was 17% of the used car financing space. So when we talk about a decline of 2%, we're actually talking about a 12% reduction in our market share. 12% in deep subprime. And it's been shifted over to the subprime finance companies. Who gained the most? Santander, who's been very aggressive in the subprime finance market space. Credit Acceptance Corporation, who's providing a lot of capital to franchise dealers, and they are being very aggressive in capturing and penetrating the market that previously was handled by the buy here, pay here market. So we've got some challenges ahead of us to just build back our market share in the days ahead. What's being financed, and this is part of the challenge. If we look at the deep subprime, the buy here, pay here space, we're usually selling vehicles 5 or 6 years or more older. And the subprime finance companies are offering newer vehicles, some brand new vehicles, to deep subprime customers. And it's very difficult for a buy here, pay here operator who's selling a 5 or 6 year old vehicle to compete with somebody who's going to put a 470 Beacon score in a brand new Dodge Ram truck. That's a huge challenge. But we have to resist the temptation to match them, and we have to hope, as we've seen in the past, that this will cycle through, because that's a short-term approach to gaining business. What's happening in the deep subprime market, and I think this may be an eye-opener to some of us. This is a graph that I've put together for the last several years, and for the last 16 years I've done benchmarks on this industry. And if we look at what's happened since 2009, we look at the red bar, which shows the average cost of vehicles. And I realize we have different models out there, and you may not be following this exact model, but this is a typical model that we see in analyzing contracts in the industry. We'll see that the vehicle cost has gone from $5,029 to $6,642 in the September 2013 analysis that we've done. That's an increase of 32%. And if we look at the blue bar, the middle bar, that's down payment. And we've seen down payment drop from $1,039 on the average to just $849. That's a little over a 12% decrease. So our costs are rising and our down payments are decreasing. That's called competition. And we've been struggling to keep our customer base by dropping our down payments. Well, dropping our down payments is like dropping your pants. They both get you into trouble. So the reality is that when you do that, it causes your cash and deal to increase. And cash and deal is a measure of risk in the buy here, pay here space. And our cash and deal has increased 45% since 2009. 45%. So that's the kind of additional risk that we're taking due to the economic conditions. But that's not the only picture. Look at this slide. This is Tom Webb, Manheim's chief economist, who provided this to me at the beginning of the year, and it shows that since 2009, what $5,000 will buy at a Manheim auction has over 30,000 more miles on it. Over 30,000 more miles. So we're getting a lot less for the same amount of money. But Tom was a keynote speaker at our recent NABD event in New Orleans, and he updated this slide. And that 117,000 is now just over 120,000 miles. So the miles are going up, and so are the costs. So we are definitely paying more for a vehicle that's not as good as it was in 2009 from a mileage perspective. Now, to combat this with a decline in down payment and repayments staying fairly flat, dealers have increased the term of the contracts on higher mileage vehicles, and we've seen the average number of weeks in these contracts go from 143 to 165 weeks. The good news is that we finally see many operators putting the brakes on, realizing that longer is not better. These vehicles are not like a bottle of wine. They don't get better with age. So the reality is that we're starting to see them be conscious of the term and controlling it. But 165 weeks is an average that we've been seeing. But it gets worse, because in the studies that I've done, on a 36-month contract in buy here, pay here, the average duration is 41 months. Why is that? Because we're working with the customers. If they have a problem, if they have a mechanical problem, if they've got a temporary cessation in their job, or if they have other life events, we're trying to work with them to provide a financial solution to their problem and a transportation solution. So now that 36 months is 41 months. And that 42 months is 48 months. And that 48 months is 54 months. And we're putting a lot of stress on the collateral that we're putting under these contracts due to the miles and due to the matching of the customer with the vehicle. But I think this is a particularly interesting slide, again, an experience slide, current second quarter data. Look at the average monthly payment for a subprime customer, and look at the average monthly payment for a deep subprime customer. They're virtually identical, and this data correlates exactly to what I have in my database. Do you think we're pricing the risk properly? Do you think that a deep subprime customer should be paying the same monthly payment that a subprime customer does? Are we being fairly compensated for the risk that we're taking? Is the subprime business being too aggressive in pricing the way they're doing? And I think this is a concern because we're not seeing fair pricing for the type of risk that is being taken. And I say to you that managing risk is the key to success in the buy here, pay here business. Why do I say that? Because we have to learn from our losses. And I hope that the regulators will take the time to understand the data and the risk that operators are taking before they put onerous regulatory restraints on us. I've looked at over 1.2 million subprime loans in the last 8 years, and at the end of the year we'll be up to about 12 billion in analysis. But more important than that, I've looked at the policies and practices that generated that data. Because the data is worthless unless you understand what practices and policies were followed in generating them. I can't emphasize that enough, that you have to understand the differences that cause some of the aberrations with the data in the subprime auto finance industry. And again, we're all following different models in some cases, but for that $6,000 ACV vehicle that's being sold for $10,500 to $11,000 with a 36-month term, the gross loss before any recoveries is now over $8,000. And the net loss is $5,500 after recoveries. And we're writing off, we're having a default rate of almost 1/3. 1 in 3 deals are going bad, the average default rate. And that's not because we're doing anything wrong. It's not because we're bad underwriters. It's not because we're selling a bad vehicle. It's because these consumers have no financial capacity. They have no ability to recover from a life event. You can work with them, you can help them, but at the end of the day, they have to pay their contractual obligations, and that's the challenge. So the lack of financial capacity is the cause, not what we're doing in the industry. I think that it's important now to focus on what successful operators are doing. What are the best practices? And I've divided these into 3 categories: operational, financial, and compliance. And I hope that all of us will send the message to all of the dealers and operators that we know that these are the things that are going to make you successful in the future. And the first is we have to be proactive and build strong customer relationships. Many of the subprime finance companies are interested in the next transaction. They're not interested in a relationship. If that vehicle breaks down, they'll just repossess it. They don't care. And we have to rebuild those relationships with our consumers and make sure that they understand that we're looking after their best interests over the long term, not just the short term. We have to implement efficient systems with technology. We have to work smarter, not harder. We have to find efficiencies because capital is very precious. We have to train personnel, and we have to establish written procedures. We have to inspect what we expect, and we must provide as management supervisory oversight. We can't blame it on our staff. We can't say, well, I told them to do that. You are going to be held accountable as management. We have to create a professional team. We have to have the right capital provider. We have to have the right attorneys. We have to have the right CPAs. And we have to employ consultants who understand our business. We have to be relationship-oriented, not transaction-oriented. And in an age where technology is so important, we can't replace the personal bond with an electronic bond. We have to have technology, but we have to keep personal relationships with our consumers. On the financial end, we have to learn from our losses and not repeat them, because trial and error mistakes are very costly today. They can cost you millions of dollars. So we have to look at where the losses are coming from and keep from repeating them. We have to review our business models and calculate the return on investment. We have to, if we're going to sink millions of dollars in this business, we have to know what return we're going to get and what to expect. We have to allow for economic uncertainty by reducing leverage. In other words, it's not illegal to have equity in your business. And it's not your desire to see how much money you can borrow, because debt has one very adverse characteristic: you have to pay it back. So the reality is we have to manage that risk by maintaining financial flexibility, because we don't know where the bus is headed. And finally, we have to have a comprehensive compliance management system which provides for written policies and procedures, which provides for management oversight, which provides for trained staff, which provides for us accepting the responsibilities of operating in this space. And the only way to do that, if you're a busy operator, is to appoint a chief compliance officer, is to go back and appoint someone to be in charge of the compliance role. So, you know, I would just say to you that I've learned more about the business from studying losses than any other thing. And what kind of guy sits around all day studying buy here, pay here, or deep subprime losses? That would be a buy here, pay here proctologist. So the reality is that I think we all have to learn from our mistakes and not repeat them. So now I'd like to turn it over to Chris. Thank you very much, and then we'll take some questions after he finishes. Thanks.
Oh, well, I don't have any slides.
Okay, all right.
I didn't come as well organized as Ken did, but I wanted to speak to you all a little bit today, and thank you so much for the invitation for AFSA to come and begin a dialogue that we hope will have many years from now and in the future. I think, as Steve said, AFSA and I are here to certainly represent lenders that are part of the indirect lending model. Ken, certainly on the buy here, pay here, we've never tried to represent that side of our industry, and until CFPB and Dodd-Frank kind of brought them into the fold or did not exempt them. Talking about the indirect model, and I'm going to talk generally because, as Steve pointed out, we do have large banks that are members. We do have almost all of the captive finance companies are members, but at least half of our vehicle finance members that we have are the small independent that deal with a lot of the members in this room. But generally speaking, I mean, this is subject of our last conference, is this as good as it gets? Because we have gone through a recessionary period 5 and 6 years ago. We have returned from that really with a vengeance. It's not because sales and volumes have increased to beyond what it was in 2004 and 2005, but as far as the lender is concerned, we've never had such good loan performance. And how do we explain that? Well, some would say that they tightened so down on the underwriting generally that they haven't been making a lot of bad loans over the last 4 years. But the truth of the matter is, people made an option about whether to make their mortgage payment or make their car payment, and they opted to make their car payment instead. So our actual number of delinquencies, our repossessions, our defaults on these loans, you mentioned 1/3, right? That we're still at kind of record lows in all of those areas. So when you have those limited write-offs, which is really the difference between big profits or no profits at all, it's not necessarily on how many you sell, but how many actually pay you back for what you have sold. So that has been very good. You tie that in with the whole capital markets, which 6 years ago totally collapsed, where you couldn't even have a securitization on Wall Street, where they're clamoring for securitizations right now. You have subprime securitizations that are not a problem. You're having the spreads and those rates are thinner than they have ever been. All of this has led to a really frothy market out there. We have interest on a lot of the independent members that we have, from hedge funds, from private equities. You're having a rush of liquidity and capital and money into the lending market right now, specifically on auto. They look at the history of auto, and although we got tagged as being as bad as mortgage, when they actually came out the other side of the recession, they realized that all of those loans that they had securitized and purchased, there was not one loss. Not one loss. So, you know, this has not gone unnoticed by investors and people that are looking for some spread out there, and realize that there's some security, some stabilization, there's some within the auto lending business. Now, how many of you have been through cycles before? All right. Auto, famous, we go from here and we go there. The sharper the increase, the sharper the fall. And that's where we are right now. We find ourselves into a dangerous kind of situation in that people are buying deeper. Competition is greater than it has ever been, which is a great thing for many people. But it also, we all must recognize that anytime we get into this type of a cycle, we will pay for it eventually. When that day of reckoning comes, we all need to make sure we prepare for. I'm going to focus a little of our discussion today, not as much on the economy. If you ask my members what is their number one concern about the future, they figure they can control their processes, their best practices, all their compliance type of operations satisfactorily, and they do a good job at that. It's the unknown that they're afraid of. And that unknown is a government that right now has a new agency or a new bureau that they're terrified of. Dodd-Frank created the Consumer Financial Protection Bureau, CFPB. As we discussed a little earlier, auto dealers were able to get themselves exempted from Dodd-Frank and from the jurisdiction or the authority of the Bureau. Don't think that exemption does not come at a price, because the President of the United States himself was very, very upset that auto dealers were able to have the power. Congratulations for having the power to get auto dealers exempted. But from day one, they have tried to figure out a way to bring them back in the fold. And what we have been told, as soon as the Bureau was formed, is we're going to use lenders, which we do have the authority over at the Bureau, to get to dealers. We're going to go through you to get to them. So how are they doing this? Well, so that's the scary part. They're doing it mainly in two areas. They're looking at, as they call dealer markup, we call dealer compensation, dealer participation, anything of a spread between the buy rate that is offered by the finance company, by the bank, whatever the financial source is, and the ability for the dealer to have some discretion within caps, but some discretion on how much is marked up on each of those customers. They're focusing on that. Next, they're going to focus on ancillary products. Now, once again, the insurance industry was able to get themselves exempted over having any authority over any insurance products, which many of the ancillary products fall under. So they have focused all their attention on the marketing and the advertising of those ancillary products, and we can get into a little bit more detail on that. But specifically on the dealer participation and on the discretion that is offered to the dealers, the way they are focusing on that is they could not find a way to do that unless they could find an avenue, a wedge. And they've focused on an arcane or an area, a theory of law called disparate impact. Any of you heard of disparate impact? Disparate impact has been used in the past in the area of mortgage and the Federal Housing Authority, which says we know that, we don't know, but we've always had authority over discrimination of which you intend to discriminate, the actual impact of that. But they have not in the past, or up until now, had authority over discrimination that might occur after the fact. You have set policies in place against overt discrimination. But at the end of the day, when you measure every loan that you have, and you look at the African Americans who have purchased or financed a car, and you look at Caucasians who have purchased a car, if there's an actual differentiation between the markup or participation between a protected class and an unprotected class, they look at that as disparate impact discrimination. So they're going after the banks, and they've requested all of their data, and they're just looking at 4 data points. They're looking at the buy rate, they're looking at the contracted rate, they're looking at the person's full name, and they're looking at their 9-digit zip code. They're using the person's name and the zip code as a proxy to identify race and gender. They're making a determination that if your 9-digit zip puts you in this location, there is a 98% chance that you are part of a protected class, for example, African American. If you are outside of that in a different zip code, you are not part of a protected class. And they're comparing those two using those proxies and making determinations based on that proxy system. They're also using names, Hispanic last names, and using that as a proxy, as a surname, and they're combining this into a system that they say they are confident and willing to go to court to justify the use of this for enforcement actions and penalties against lenders. Now, the status of this today is the scariest part, because we continue to have meetings with CFPB on a fairly regular basis. And we meet with Director Cordray, who is finally, if you remember, we challenged the appointment, which was a recess appointment, and then Director Cordray eventually was confirmed by the Senate. So he's in the job for 5 years, and quite honestly, he's a pretty nice man. When you go to meet with him, he says all the right things. He says these are very complicated issues. He says we are still studying them. We have not made any specific determinations on how we're going to handle them, and he'll have all his deputies in the room when you're talking to him. On the other side of the building, we have enforcement and Justice Department, which is specifically threatening many of the banks that are currently under their jurisdiction and have been under examination for the last 2.5 years, and threatening to have an enforcement action of millions and millions of dollars of penalties against them tomorrow. So it's not unusual for the government to proceed along a dual track. You've got the one political side saying we're looking at it, we're still deciding what we're going to do, and that train is going down that track. You have the enforcement side, which is racing ahead on a whole different track, threatening, cajoling the reputations of these businesses. And please remember that when you're talking about some of these banks, you look at Bank of America, which has had the countrywide, all of the problems that they've had over the last years. You're looking at Chase. It seems like JP Morgan Chase is often in the headlines outside of the auto industry, but for other issues, unrelated. You look at Ally Financial, which is still 74% owned by the federal government. These organizations have a huge risk, and they want to get this issue behind them. They have what we would call regulatory fatigue. They've been hammered on for so long, they just want to settle, they want to get this behind them, they want to move on. But moving on means, according to CFPB, there's one of two options in the area of discretion that is given the dealers. You can either monitor those dealers, and if you find out that they're discriminating, whether intentional or not, in any way, you need to take action against those dealers. That's one option. Number two option is go to a flat fee. No discretion there. We're not telling you how. The government is certainly not telling you how much the flat fee is. They're not telling you how you should do it, whether you should have ranges, whether it should be a percentage, whether it should be a set amount, but it should just be flat, and therefore there's no discretion permitted. Well, we have proved to them, or certainly gone to them and said, if flats were easy to do, we'd do it. If it was easy as tomorrow going to a flat fee, our members would have done it. But if your flat fee over here is Y, and your flat fee over here is X, and you have a different system over here, doesn't it give incentive, misaligned incentive to the dealer to go to the highest rate for compensation that they can, and how is that going to benefit the customer? And doesn't that have the possibility of that steering to actually magnifying the problem? Instead of making it better, you might be making it worse. When we go to that, tell them that, they don't care. They say, we only have control over lenders, and if the lender is paying a flat fee, that's all that matters to us. So we're trying to go to Congress, ask them for the methodology that they're using. We had letters sent over by members of the House, bipartisan, I should say, just as many Democrats as there are Republicans. In the Senate recently, we had 22 senators, 11 Democrats, 11 Republicans, sent letters to the director at CFPB saying, what are you doing? How are you doing it? How are you making these determinations? The response has been basically a non-response. This is an agency that says we want everything to be transparent, we want to be open and honest for everything that we do, and they are the most secretive bureau or agency that we've ever worked with. The FTC was totally open in comparison to what the Bureau has been. Things are rushing along at a pretty quick pace. We talked about the letters from the Senate. Last week, on Wednesday, we received an announcement from CFPB that they were going to have an open forum to discuss this issue. Guess when? 2 days from today. They announced it last week. 2 days from today, we're going to be participating on one of those panels representing industry. They still have not finalized who is going to be on the various panels, but we look at this as a check the box. We can say we've been open, we've been transparent. It will be a webcast to the public. Any of you can get the address and sign in and look at this. We met yesterday afternoon with a special task force that we've appointed of CEOs representing a broad spectrum of the industry, and we have decided to go forward and conduct our own study. We'd like to work with your organization. We've approached already other organizations that want to participate. We're going to get data from our members. We're going to truly look at this in an unbiased way, look at what alternatives are out there. We're not saying that status quo and the way things are being done today is absolutely the way that they have to be done tomorrow. We're not here to say that there is no potential discrimination out there, a disparate impact. We're going to look at the whole thing. But what they have not done in forcing the industry to make wholesale changes to a system that has worked so well for so long without doing any type of an impact analysis to say, if you went here, number one, would it make it better for consumers? Would it make it more expensive to consumers? Would it hurt access to credit? Would it affect affordability? What impact would it have on dealers? What impact would it have on lenders? Is it sustainable? Imagine recommending a program they don't even know whether it's sustainable for the industry. So these are some of the questions that we are addressing, as well as some of the ones that Ken mentioned. I think from our standpoint, things have never been better than they are right now business-wise, and they've never been scarier at the same time. Thank you.